So I'm not going to have slides, so you can kind of relax your eyes for the next 10, 15 minutes. Like it was introduced, I'm the CEO of Cabrillo Advisors, and actually I'd say we are, as Brian suggested, in the tadpole stage as a firm. What I initially launched the business to do was help people with M&A. Specifically, had an opportunity early in my career to work with Michael Dell, selling companies, buying companies, and found that to be really fascinating, was more tuned into what the entrepreneur was going through, and set up my firm in 2001 to represent those types of companies. Along the way, people started asking me, what is my value? What am I worth? Is it the time to sell the company? Should we take on capital? And over time, we developed that capability within our firm as well. And that's the topic that I was going to speak on today. So as a firm, we serve about 600 companies. A lot of you in the room actually are clients or have come in contact with us over the course of the years. Why people value their company, in addition to just selling it at the end, granting stock options, transferring assets for estate and gift, financial reporting, divorce, partner buy sell, and fairness and solvency for some of the larger public companies. But to be honest, most people think of their valuation person as a boring adjunct to the accounting person who's also boring. As Brian suggested, I was in a CPA for 2 years, did not enjoy it, didn't find it to be very dynamic, didn't find myself really working with CEOs on the key issues that were of most importance. So kind of moved away from that, did a marketing degree, and kind of moved into M&A as a side business. But what I really found with this valuation entity that we've now created are the many ways that we can help the business owners preserve the value that they're creating. People work really hard to follow a passion. To build a company like UGG took years, maybe decades. And the question I always ask the entrepreneur, how much have you done from a hygiene standpoint to protect the value you're creating? Either corrected from investors, protected from people that are what I would call bad guys that are trying to take the value away from you as you work really hard. So that's the positioning of a valuation guy as a good guy. So we're here to help you with that asset protection and wealth creation event, because making money is hard enough and protecting it is critical. So there's a number of situations where you're going to come in contact with what I'll call a bad guy. A bad guy could include a buyer or investor, somebody who's trying to either buy your company at below market or make an investment that's in their favor. I'd be curious to know at some point how much of the company $20,000 cost. But you'd be surprised sometimes how that little investment costs a significant portion, even control of a company. Another of the bad guys that we all run into is the IRS. And hopefully I won't get in trouble with our friend who spent some time in the IRS. But certainly with stock options, I'm assuming a lot of you have granted or have had stock options at some point in your careers, as well as the estate side. And then the other two that come in contact more often than not are business partners that fall by the wayside, and you have to take care of that separation or business divorce, or a personal divorce where you have a spouse that's looking to assert a high value on your company in exchange for other assets that might be more liquid. And we all want to protect those. So if you're a public company, valuing your business is a snap. You Google the stock ticker and you know what you've got. If I've got 2% of a large public company, multiply that out and that's my value. But with private companies, you don't have that option. There's not a ready market to assess the value. And a lot of times it's situational. Particularly difficult businesses to value are ones that are R&D specific. So if you're somebody who's inventing a cure for a disease or a new tech asset, application, security function, there's really not a value that it's easy to ascribe. So you need to bring in somebody that can help you either define that value or rebut somebody else's value as they're looking to take this away from you. The word value has a lot of different meanings depending on the context. And I'll throw out a few of those that people hear from time to time. And you might ask yourself, God, I thought I knew what that was until I heard the second one. And then the third one, now I'm not sure which is which. But for definitional terms, fair market value is the price at which an asset would exchange between a willing buyer and seller, neither under any compulsion to buy or sell, or both having reasonable knowledge of all relevant facts. That's a lot to remember. Investment value, value to a particular investor based on that individual's requirements and expectations. Intrinsic value, that's the value, fundamental analysis of companies, particularly publicly traded ones. And lastly, fair value, the price that would be received to sell an asset in an orderly transaction between market participants. So not being classically trained in valuation, those all sound the same to me, and I'm not really sure if I was going to value my company, what kind of valuation am I talking about? Do I really need it? Who's going to look at it? What's the protection I'm buying from that? And I would say based on the purpose of what you're looking for, the valuations that you're looking for are also governed by different entities, whether that's a Big Four, it's an SEC, could be the IRS. So it's important as your advisors might bring in somebody to say, hey, this guy can help you think about what the value of your company is. It's situational and it's event-driven. It's not a global valuation for all purposes. So let's consider the one that's probably the most prevalent in this room, which would be the stock option plan. And just by show of hands, how many companies that are represented in the room actually issue stock options to their employees? So not so many. Is that because people are privately held and closely controlled? Yes. Would be the point, okay. So for a lot of companies that actually do have employees and are looking to use that as one of the incentive tools for getting the best employees, keeping people focused on task, they'll want to give options that are priced in an attractive manner. So what does that mean? If somebody's giving an option to an employee, you want them to have the most upside for that grant to be taxed as a capital gain, not as an ordinary income. So there's pressure to get to a low value, but the reverse pressure is IRS, SEC, Big Four, looking to see that value be higher because they want to see a conservative treatment and they want to see you pay more taxes. So that's what the good guys do. The good guys come in and we work with the team to position the business in the most favorable light with the highest levels of discount to give those employees options that are going to have a lot of upside. An example for one of our clients that just recently made the cover of Forbes was a young Indian gentleman, 29 years old. He purchased an asset out of Glaxo for about $5 million. 8 months later, the company was public at $2 billion. So there's a lot of value that was created in a very short amount of time. And the valuation that we did was essential in the SEC reporting to giving those people that got the options protection. Now, funny enough, it's one of the employees was his mother and one was his sister, and there's a lot of talk about the $29 million of value that they earned in that short amount of time. But at any rate, that's a lot of money, and you can kind of see how that would make a big impact. Another area where you're going to find somebody trying to steal the value that you've created is around estate planning. And so for people that have had a large wealth event, you may already know this, but strategies that you employ early in the business can pay huge dividends later in the business. As an example, one of our clients had a wealth event where about $100 million of value was earned by that owner in the transaction. By having some estate planning techniques that were implemented only 8 months before, they were able to save $15 million on their overall tax bill. So again, owners focus a lot of times on building the business and really focusing on what it is they do, the service, the customer service, but they often neglect themselves. It's the cobbler with shoes, not taking care of their own estate. So while I don't do estate work, we work with a lot of those types of advisors who are looking out for your best interest and need somebody to have an expert third party validate what it is they're trying to accomplish with the strategy and make sure that it's defensible when it is reviewed, and it almost always is reviewed. The next one that I mentioned, partner buy sells and divorce. And again, I won't ask people to raise their hand on that, but I've been through one of each, and I can tell you it gets messy. People on the opposite side of that transaction are going to really work hard to assert a lot of value in your business, largely because they know that it's your passion, and that's the thing that probably makes you most concerned in the separation or the divorce, is hanging on to the control of that asset. So by putting a higher value, and there will always be somebody on that side of the equation asserting that the business is worth a lot, because now they can use that as leverage to trade for cash, for other assets that you might have, or just an interest in the business long term. So a valuation person in that instance comes in and really works to create a more rational value argument for the person that's the incumbent who's not leaving, and to make sure that when the two valuations come together, you're actually the one that's going to win that distributive agreement. So again, it's not that every business will have that, but a lot do, and especially when you have sole business owners, it's something to be considering when you're going into that situation. Make sure you're armed with all the weaponry that you can. And the one that I'm probably most passionate about, and was really the initial discussion point that we had, is when you go to sell your business, what are you worth? And I think that's the one that most business owners probably think about most frequently, because you have a vision, you have sometimes a point at which you think you want to be exiting the business. And so knowing when is the right time to sell, when you receive an inbound offer, is it a good offer? Have you got something that you really want to take action on? And so we'll often be brought in to at least initially assess a situation, help you think about what are your competitors being valued at, in the trajectory of the business, is now a good time or it's not a good time to potentially consider that offer. And ultimately, if the decision's made to move forward, the best way to determine value of a privately held company is to run a process. And I can tell you we've had some good and bad situations that have happened with what I'll call single shot opportunities, where somebody came to you, they made you an offer, you say, wow, that's a lot of money. It seems like it could be a good situation. I don't want to mess that up. So I don't want to bring in a bunch of advisors. And frankly, having worked on the buy side, that's exactly what I want you to do. Because I don't want you to be exposed to the market value of the company. I don't want you to be thinking about, well, if he's willing to pay 10 million, maybe somebody else could pay 15. And I always draw this analogy. If somebody knocked on your door and said, hey, I want to buy your house. And they said, I looked at the tax roll and I see that you bought it 20 years ago and paid 500,000. So I'm thinking $1 million sounds really good to you, right? Some people actually would be, wow, that's twice what I paid for it. And in business, a lot of times that happens. You've anchored your mind on something that was much longer in the past in terms of what you put into it, how long it's been going, et cetera. So you're nervous to try and risk that exit opportunity by exposing that buyer to any extra process, red tape, or difficulties. But I can tell you 90% of the time, that's not a good strategy for you. You're going to most likely have the value depressed. You're going to find that the terms and conditions, which a lot of times are not on the forefront of a deal when it gets announced, how much of that was cash? How much of that was earnout? How much of that was contingent on your staying for some period of time? And so these are all the things that in that type of evaluation situation, you're really focused on the totality of the offer, making sure you've exposed the company, to the maximum potential buyers, specifically unique buyers, somebody that would look at your shoe company and say, it's not just a shoe company, it's a brand, and other things I can do with that brand in addition to what's currently being done. And that's where you get really strategic value on a sale. So in summary, the statement, what's my true value? It's always safe to say that it's worth what somebody is willing to pay for it. But in the other instances of when you're looking to do one of these types of transactions, either raise money, exit a partner, these sorts of things, understanding the frontiers of risk that you want to take on the transaction. You want to be aggressive, conservative, key. Make sure that you're playing within the guidelines of whoever is going to be downstream of you reviewing it. So estate planning, as an example, almost always gets audited by a gift tax return. So you want to make sure that the strategy is going to hold water. It's no point doing something ultra aggressive that ultimately gets kicked back or disallowed. And then lastly, make sure that your team is all focused on the right path. So that's CPAs, tax people, attorneys. Each of them has some angle to the picture that by themselves they won't have the complete story. But in totality, they'll help you get to a better outcome. And I think that's the point, for a group of business owners like you. You've built something, it's got value, protect it. Make sure that most of that value goes to you in the end and not to the other parties that are sort of in the ecosystem. So again, Wade Hansen, Cabrillo Advisors, and sorry I didn't have more slides for you, but I'm getting the hang of the TED Talk now. I know we'll have some cartoons for next time. All right, thanks.
Thank you. Wade, thank you.
Thanks.